Retirement is a time to relax, to enjoy the slower pace of life, and to finally spend time on things that truly matter. But even in retirement, financial planning doesn't stop. In fact, it becomes more important than ever. One of the most trusted options for senior citizens in India is the Senior Citizen Savings Scheme, or SCSS. Let's talk about what it is, how it works, and whether it's the right fit for you or your loved ones. The Senior Citizen Savings Scheme is a government-backed, fixed-income investment scheme designed specifically for individuals aged 60 and above. It offers safety, reliability, and most importantly, a regular income, something every retiree looks for. Those who have taken voluntary retirement at age 55 or above can also invest, provided they do so within 1 month of receiving their retirement benefits. Now, how much can you invest? The minimum is just 1,000, and the maximum, recently revised, is 30 lakh. This cap applies per individual, which means both spouses can invest separately, effectively doubling the household limit to 60 lakh. The tenure of the scheme is 5 years, and you can extend it once for another 3 years. What makes SCSS stand out is the interest rate. As of now, it offers 8.2% per annum, and the interest is paid quarterly, so you get a steady flow of income throughout the year. In a world of falling fixed deposit rates, that's a pretty solid return for a low-risk option. Let's look at the advantages. First, the returns are among the best in the fixed income space for senior citizens. Second, it's backed by the government of India, which means your capital is safe. Third, the quarterly payouts help cover regular expenses like medical bills or household costs. Fourth, investments up to 1.5 lakh are eligible for deduction under Section 80C of the Income Tax Act. But like every scheme, it has its limitations too. The most important one is taxation. While you do get the 80C benefit on the investment, the interest earned is fully taxable. If the interest in a financial year exceeds 50,000, TDS, or tax deducted at source, is applicable. However, if your total income is below the taxable threshold, you can avoid TDS by submitting Form 15H. Another point to note, 30 lakh might not be sufficient for those with larger retirement savings. Also, premature withdrawal is allowed only after 1 year, and it comes with penalties. 1.5% deduction if withdrawn between 1 to 2 years, and 1% if withdrawn after 2 years. So, should you invest in SCSS? If you're looking for a safe place to park your retirement corpus and generate steady income, then yes, SCSS is one of the best options out there. It's easy to open through post offices or authorized banks, and it requires very little maintenance. On the other hand, if you're in a higher tax bracket and don't necessarily need quarterly payouts, you may want to consider more tax-efficient options like debt mutual funds or tax-free bonds. In conclusion, the Senior Citizen Savings Scheme is a sensible, stable choice for retirees who value security and consistent returns. It might not be perfect for everyone, but for many it's a cornerstone of a well-planned retirement. If you found this video helpful, don't forget to like, share, and subscribe for more content on personal finance and smart investing. Until next time, stay informed and invest wisely.